Welcome Stock MOE. Somewhere right now, there's a guy in his early 50s sitting at his desk doing the same job he's done for 20 years, wondering if this is really it. Wondering if there's a way out before 65 comes around and steals whatever energy he has left. If that sounds even remotely familiar, stay with me for the next 12 minutes. Because what I'm about to walk you through might genuinely change how you think about money, income, and your time. Before we go any further, if you're new here at Stock MOE Hype, tap that subscribe button right now and hit the bell. We talk real numbers, real strategies, and real income ideas for people who are serious about their financial future. No get-rich-you nonsense, no hype without substance. Real stuff that works. Let's get into it. Here's the core idea. Most people think you have to choose between two things. Either you invest for growth, meaning you park your money somewhere and hope it multiplies over 10 or 15 years, or you invest for income, meaning you collect dividends and distributions right now to cover your bills. What I want to show you today is a 3-stock system that does both at the same time. It generates over $1,000 a month starting almost immediately, and it's building toward a portfolio large enough to fully replace your job income within a decade, maybe less, depending on how aggressive you want to be. Now, I know what you're thinking. $1,000 a month sounds modest, but here's the thing. That $1,000 a month isn't the goal. That's just the pressure release valve. That's what keeps you from having to touch your growth stock when the market dips and you're feeling anxious. That monthly cash coming in lets you stay patient. And patience, more than any stock pick I'll ever give you, is what actually makes people wealthy. So, let's start with the first income stock. Trinity Capital, ticker symbol TRIN. Now, Trinity is what's called a business development company or BDC. Most people have never heard that term before, and that's fine. Here's what it means in plain language. Trinity is essentially a lending institution, but instead of lending to giant corporations, it lends to small and medium-sized businesses that can't easily access traditional bank loans. In exchange for taking on that slightly higher risk, Trinity gets paid back with high interest. And because of how BDCs are structured under the tax code, they have to pass most of that income directly to shareholders as dividends. That's why the yield is so unusually high. Right now, Trinity Capital is sitting at about a 12.5% forward dividend yield. Over the past 12 months, it's paid out around 13%. And here's what I think is really underappreciated about this one. Over the last 5 years, Trinity has grown its dividend by 51%. You're not collecting a flat, stagnant payout year after year. You're collecting more money each year, while your initial investment stays the same. That's a compounding income story, not just a yield story. And that distinction matters enormously for long-term income replacement. The loan portfolio behind this dividend is built carefully. About $1.80, $8 billion in secured loans spread across 95 different companies. Then another $336 million in equipment financing across 22 companies, all of it backed by physical assets. In its 17-year track record, Trinity has deployed $5.5 billion in capital across 463 investments and successfully exited 269 of those. That's a proven seasoned operation, not a startup. Now, let me address the elephant in the room, because if you followed the private credit space this year, you've heard some concern around BDCs. The worry is specifically about software as a service companies that many private lenders have exposure to, and whether AI disruption is going to undermine their ability to repay loans. It's a legitimate concern, but here's what sets Trinity apart. Only about 9 to 10% of Trinity's loan book is in that software as a service category. The rest sits across manufacturing, finance, insurance, and equipment-heavy industries with real tangible assets behind them. The specific risk that's been pressuring other BDCs is a small slice of what Trinity actually holds. Does it sell off when private credit fears spike? Yes, but it bounces back quickly, and that behavior tells you the market isn't questioning the quality of this company's core portfolio. And on top of everything else, this is a monthly payer. You're never more than a few weeks away from your next check. Now, let's move to the second income source, and this one requires you to keep an open mind for a moment. This involves the iShares Ethereum Trust, ticker ETHA. Before you scroll away because of the word crypto, the actual strategy here has almost nothing to do with gambling on Ethereum price movements. The income approach we're using is a covered call strategy, and this is something serious income investors have been doing on stocks and ETFs for decades. Here's how it works. You buy shares of ETH in blocks of 100 shares. Then you sell call options contracts against those shares. When you sell a call option, you're agreeing to sell your shares to another investor at a specific price if the stock hits that level by a certain date. In exchange for making that agreement, they pay you cash up front. That cash is your income. For example, if ETHA is trading around $1,762 per share, and you buy A000 shares for about $17,600, then sell 10 call option contracts at a strike price of $19 expiring roughly a month out. Those options are paying about $74 each right now. That's $740 collected immediately. Divided by your $17,600 investment, that's roughly a 4 to 4.12% monthly yield. Think about that for a second. 4% monthly. Your manufacturing income from an asset that pays no dividend on its own. If ETHA climbs past $19 before expiration, you sell the shares at that price and pocket a nice 8% gain on top of the premium already collected, then buy the shares back and repeat the following month. If ETH stays flat or dips slightly, you keep the shares and keep selling calls, collecting that premium every single month. This strategy does require a bit of learning if options are new to you, and that's completely fine. Take the time to understand it properly before using real money. But it is genuinely one of the most powerful income generation techniques available to individual investors today. And the underlying asset matters too. We are entering a real era of financial tokenization. Robinhood has already tokenized thousands of stocks. JP Morgan, Amazon, and Walmart are building their own stable coins. Goldman Sachs is moving toward tokenizing the $7.7 trillion money market industry. Ethereum is the infrastructure that most of this tokenization actually runs on. ETH at around $17 right now, sitting well below its previous high of about $35 per share. There is meaningful upside here beyond just the premium income, which is why holding the shares rather than a different structure makes sense in this particular strategy. So now with both income stocks in place, Trinity Capital's monthly dividend and the covered call income from AIA together produce over $1,000 per month in passive income from roughly 2/3 of the portfolio. That income is not the finish line. That's the base camp. That's what takes the financial pressure off. While the real wealth building happens in stock number 3. And stock number 3 is Credo Technology Group, ticker CRDO. This is the growth engine and the one I'm most excited about for pure upside potential. Credo operates in what I think of as the plumbing layer of artificial intelligence infrastructure. When massive AI models are running inside data centers, they generate enormous amounts of data that has to move between servers, between chips, between racks constantly and in real time. The bottleneck inside those data centers isn't the processors. It's the networking layer, the ability to move data fast enough and efficiently enough to keep pace with the computation. Credo makes the chips, cables, and optical interconnect products that solve exactly that problem. In the current AI build-out environment, that is not a nice to have. It is a must-have for every major data center operator on the planet. Now, here's where the numbers get genuinely compelling. Over the past 12 months, Credo has grown its revenue by 226% year over year. Not 26, 226. Compare that to peers in the same networking and data center infrastructure space, including Astera Labs, ticker ALAB with around 115% revenue growth, Arista Networks, ticker INET, at roughly 28% and Broadcom, ticker AGO, at about 25%. Credo is growing at roughly double the pace of its nearest competitor. Forward analyst estimates for the coming year show approximately 120% expected revenue growth for Credo. Again, about double what's projected for anyone else in the comparison group. And before anyone questions whether this is just revenue growth without profitability discipline, gross margin for CTO sits at about 67%. And the operating EBITDA margin is around 32%. That operating margin is actually stronger than Asterab's on an efficiency basis and holds up well even against the more mature and scaled Arista Networks and Broadcom. This is a company that has figured out how to grow profitably, and that combination is rare. Now, here's the most important thing about why Credo specifically rather than one of the bigger names: market capitalization. Credo's total market cap right now is approximately $32 billion. Compare that to Broadcom at roughly $1.9 trillion. Broadcom has delivered extraordinary returns for those who held it. But the math becomes difficult at nearly $2 trillion in market cap. For Broadcom to 10x from here, it would need to become a nearly 20 trillion company, roughly two-thirds the size of the entire US economy. For Credo to 10x from here, it becomes a $320 billion company. That's large, but entirely reasonable given how other AI infrastructure names have scaled. The ceiling on Kratos's upside is just fundamentally larger than what the mega-cap names can realistically offer at these valuations. On the valuation side, Kratos trades at roughly 52 times earnings and about 28 times trailing price to sales. When you adjust those multiples for the growth rate, the growth-adjusted valuation comes down to something closer to 14 times sales. For a company with this competitive position and this growth trajectory, that is a reasonable entry point. Now, let me bring all three stocks together and show you how the math plays out, because this is where it gets really exciting. Starting with a $50,000 portfolio, we put $10,000 into Trinity Capital for the monthly dividend, $20,000 into ETH for the covered call income, and $20,000 into Credo for portfolio growth. With two-thirds of the portfolio in income-producing positions, you're generating just over $1,000 a month in passive cash flow right from the start. Every 3 years, the plan is to rebalance a portion of the Cradle gains back into the income stocks. This does two things simultaneously. It locks in growth stock profits before any potential pullback, and it increases the size of the income-generating allocation, which means your monthly cash flow grows over time. By year 6, monthly income is approaching $1,700. By year 9, it's around $2,400. And by year 12, after a full rebalance into the income positions, you're looking at over $5,000 a month in passive income. If $5,000 a month would cover your core expenses, and for most people in their 50s, especially with a mortgage mostly paid down, it absolutely would. Then at year 12, this portfolio has effectively replaced the need to show up for a job. Not because you got lucky, not because some volatile stock went parabolic overnight, because you followed a disciplined system, collected income every single month that kept you patient, and let a high-quality growth stock do what high-quality growth stocks do over time. If you want to compress the timeline, you could keep more of the portfolio in Credo for the first several years and skip the immediate income to maximize growth. That path could potentially get you to full income replacement in 7 years, or you can stay with the income split described here, but reinvest all of the Trinity and ETH payouts back into Credo instead of spending them, which accelerates the compounding. There are multiple ways to tune this depending on your specific situation, age, risk tolerance, and what you actually need right now. Drop a comment below right now and let me know which of these three stocks you find most compelling. Is it the Trinity Capital income play, the Ethereum covered call strategy, or the Credo growth engine? Every comment gets read and your questions genuinely shape what we cover next here at Finance Hype. If this gave you something useful today, share it with someone who needs to hear this. It takes 2 seconds and it could genuinely redirect someone toward a better financial future. The stocks one more time so you have them clear. Trinity Capital, ticker trend for monthly dividend income. iShares, clears throat, Ethereum Trust, ticker ETHA for the covered call income strategy, and Credo Technology Group, ticker CRDO, for portfolio growth. 3 stocks, 1 system, a clear logic, clear income targets, and a realistic path toward not needing a paycheck from anyone else. The people who look back 10 or 12 years from now and feel genuinely good about where they are financially are going to be the ones who made a decision at some point and followed through on it. Not perfectly, not without adjustments along the way, but consistently and with a plan. If today is that day for you, that is a very good thing. Until next time, stay sharp, stay patient, and keep